Even the most aggressive investor may not be comfortable being 100% super growth equities. So what goes into that equity bucket, I think, will matter depending on the risk tolerance that each individual has.
All right, Charlie, welcome.
Thanks.
One of the old guys is actually going to talk about saving in your 20s, 30s, 40s, 50s. We're getting closer to you now in how you should allocate across different decades.
Okay, so a lot of broad topic there to discuss. When you're young and you're 20, you pretty much have the sky's the limit. You can be as aggressive as you want. So, I mean, that's 100% equities. Same thing into your 30s. Once you start crossing into that 40s, 50s, 60s, now we start to bring bonds into the equation. So over time, you slowly work your way into it. And of course, a lot depends on what's going on in the fixed income world and where rates are to begin with.
So beginning 40s, 50s, 60s, you say you introduce bonds.
That's correct.
So Tom, how does that work for you?
I'd be a little later, and I'd keep equities longer, a higher percent of equities longer. I would probably keep equities to you within 5 years of retirement. Basically almost 100% equities.
Ooh, you're aggressive.
Well, that's what you do personally, right?
Well, I'm 100% equities at all times because it's a superior asset class long term. And I'm a young guy.
Understood.
No, but most people figure if we have a bear market, you could probably recover within 3 to 5 years. And so as long as you're willing to take that risk, I don't see why you want to have bonds. If you want to stretch it out a little bit, maybe you can go up to 10 years before you retire. But again, I think that's generally, historically, stocks will outperform bonds over any reasonable time period.
We say 100% equities at a 20-year-old, 30-year-old, somewhere in that vicinity. Equities is a pretty broad basket, right? I mean, how do you narrow that down? What do you is it the company you work for? Do you load up on that?
No.
No? Okay.
The answer is no. It didn't work out well for Enron.
Sure.
And Williams. The answer it sort of goes to the it depends bucket. How aggressive are you as an investor? I mean, even the most aggressive investor may not be comfortable being 100% super growth equities. So what goes into that equity bucket, I think, will matter depending on the risk tolerance that each individual has. And if they are super aggressive, they're going to try and find that lightning in a bottle, that next Amazon. Whereas if they're a more conservative equity investor, my guess is they will have more value-oriented, maybe more dividend-oriented, more Warren Buffett style stocks that they're more comfortable with and sleep at night with.
And that I actually agree with. It doesn't mean you have to have the same type of equities for your lifespan. So as you get closer in your 40s and 50s, you might want to then look at more dividend equities, value equities, more less volatile equities. And if that's not conservative enough, then you would need to add bonds.
So if I follow that and I think about the last 10 years, and I'm a guy in my mid to late 50s, I should be more focused around that. I would have missed out on all the action for roughly the last 10 years.
If you were a
dividend
and value oriented,
Buffett,
you would not have missed out. You would not have gotten the lightning in a bottle. I'll use that phrase again. That those big 7 names, really since we came out of that financial recession in 2009, 2010, that was the 10 to 15 years of growth equities, and specifically the rise of Apple, the rise of Google, the rise of Meta. The bet is that going to happen again? Is it going to happen to those guys again?
Yeah, I agree with you. You would have made money. You wouldn't have made as much money if you were in growth, but I thought that's we're in a 3-generational high where growth has outperformed value. So it's by 7.5% of the last 30 years. So that's very rare.
Yeah, I get that. I'm a listener. I'm a viewer watching this, and I'm 20, I'm 30, I'm 40. I know I should have some equities. And you're saying, well, maybe a little value, a little growth. Can we get a little more granular? Let's roll up our sleeves a little bit. Let's talk about how would we tactically allocate to, is it an ETF that's a broad index? Do I look at what's hot now? Do I look at what used to be hot and is now a big, deep value? What are some things that people can actually put into place?
So I think my answer depends on what kind of a investor, what kind of homework are you willing to put into this? If you are somebody who really just wants allocation, you just want to be there, a couple of ETFs, that large, mid, small, international, growth, value, pick that bucket or that right mix. If you're somebody who really likes to do the homework and pay attention and read some 10Ks and Qs, to go to the websites, the investor relation websites, and keep up with the companies, then I'd say you can have a basket of securities and give it a shot. But if you don't spend the time, you shouldn't really be in the individual equities.
Okay. And I assume that's why investors, even at an early age, should seek counsel, figure out the right financial plan. How much should I be saving based on what I'm making? Where should I allocate it? And how should I deploy it?
Absolutely. I mean, I think that even from an early age, and for if folks are in their 20s, you ask your parents, or your parents have financial advisors or friends to give you kind of started on the right track. I think that it's admirable when students and 20-something, 30-something-year-olds start to do the homework, because now that makes them more vested in the market. When they see a security go up, it makes them more interested and excited in doing more of the homework. But always seeking financial advice from advisors who spend their whole career doing it is wise.
And speaking of advisors who've spent their whole career doing it, I failed to ask you in the beginning, how are you qualified to have this conversation? What's your background?
So my background is I was not part of financial advisors talking to clients. I came from the institutional world, where I was born and raised picking stocks. I was an accountant, CPA. Went back to business school to find out what I want to be when I grow up. And I came out with equity analysis and portfolio management and all those types of courses, took the CFA exam and got that behind me as well. And then started my career kind of on Wall Street. And I was working for Bank of New York. I worked for Chubb, the insurance company. And I spent 15 years as the head of global equities for Honeywell's $25 billion pension plan. So I've been in the weeds of stocks my entire life and talk to companies, go to conferences, talk to the CEOs and CFOs, talk to all the analysts on Wall Street. And I find myself here now talking to people, which is a whole different light than what I'm used to doing.
And that's all I've ever done, work with high net worth people for over 30 years, and where you deal with different issues, where sometimes they'd sacrifice return to pay less taxes, which is contrary to what an institutional investor. I mean, they'll if you're underperforming the index, you're on the bubble. Whereas many clients can't handle index type volatility, and they have to they're willing to take lower returns for less. My favorite word, my favorite line: the sleep is highly underrated, and if they're and they can't take their volatility, and they don't have as long a time horizon as an institution where they may be limited time, so they have to be more conservative.
One thing I have learned my whole career has been talking about basis points and relative basis points to benchmarks, and it's all in percentages. We're 200 basis points above the index. We're trailing by 50 basis points. Here, it is people, and people have emotions. And on the way up, Yeah, I'm up 10%. Joe, what are you up? I'm up 9%. And on the way down, I lost $200,000. They talk dollars on the way down, they talk percentages on the way up. And I've only talked percentages my whole life because it's just a bunch of zeros when you're in an institution.
And they always judge what they're down from the high, which, an institution would never do. So it's, well, I'm down 19%. That's from the high, not what you are, over year to date or in a trailing period, because no manager judges himself on his return from the high. It's based on, some inception date to the ending value. And, but, clients, I've lost so many hundreds of thousands of dollars. Well, not really. You're just giving back some of the gain, hopefully, you've made over several years.
Yeah. Well, investor psychology is completely different. We could have multiple shows just about that alone.
Yeah, we're paid. Actually, we're paid to be a sounding board and to talk people out of making irrational decisions. I mean, we do it almost every day.
Individual equities, individual bonds, ETFs, funds. We've had some other podcasts where we've talked about alternative investments and finding other ways to either smooth out the ride for investors, create better asymmetrical skew, upside, whatever the case may be. Where do you see that fitting in? At what age? And, Tom, I'm curious your perspective because you deal with a lot of private equity, a lot of private debt individually for clients. How do you guys view that?
It's been a nice addition to our ability to asset allocate and diversify clients with the lower risk without using more traditional fixed income, which many times work, but sometimes doesn't work. Didn't work in 2022, where bonds were down, were becoming more correlated with stocks, so it was not as much of a diversifier as normal, where alternatives seem to be less correlated with traditional equity stuff. So it's another way to diversify and lower risk.
I think it's a fantastic addition that you think about it in the past. And from my experience of being at a pension plan, we had quite a significant allocation. But for the most part, a lot of this was not accessible to the common person's portfolio. And now it is. And now there's lots of different avenues that you can commit, as low as, $50,000 toward a private equity or a private credit firm. And that's something that, over time, the numbers have proven it, that it actually adds return and lowers risk if it's part of your portfolio. So I'm thrilled that we've arrived there, and I'm sure down the road there'll be even more offerings.
You can tell it just by the acceptance in foundations, endowments. The larger institutional accounts have really taken alternatives as a nice additional way to asset allocate. They'll have significantly more percentage in alternatives.
Yeah, and I don't think that there's, you mentioned age, I don't think there's anything that prohibits an age restriction as long as there's enough money to qualify to buy into these. That, even if you're 25 and you have money, having a piece of private equity as a substitute of the equity, I said 100% equities, be aggressive. Having a piece of private equity in there would be wise.
Thinking back a long, long time ago when I was in my 20s, it probably so far back you might not be able to remember.
I don't remember.
But think about when you're younger, you have kids, you're not making as much money, and there are a lot of places to save, a lot of places to invest. It's in a taxable account. It's in your 401k. It's putting money aside for your kids in their HSA or their educational savings accounts, those types of things. What's the best way for someone to determine where they're allocating, how much? Do I do all of them? Do I fund one first?
I think that the easy answer is you fund the retirement first. If you work for a company that matches your contribution, that's free money that you'd be walking away from. So I know it's difficult, and when you have a number of kids, you've got priorities everywhere for where your money needs to be spread out. But the first thing I think you should do is pay yourself and take advantage as much as you can swing into your retirement accounts and absolutely capture that match.
Especially if there's a match, right? If there's a match, that's free money. So you want
100% return is not bad.
Right.
Yeah, guaranteed.
And you start having little ones, and I know at the time you're not thinking too much about college and what those costs are going to be. But the pain is a lot less if you've been putting a little bit each year into it, and maybe you get a gift from mom and dad every now and then, or something to increase those 529s. The compounding over 18 years makes a real big difference. And I know from my experience of having 4 kids, I try to do the envelope theory where you put a little bit of bonus in every single envelope each year, and it certainly made paying for college a lot easier when you already had the buckets mostly full.
Absolutely. Well, we've covered a lot today. If I think about everything we've chatted about, it seems to me start early. You can take more risk when you're younger. You have a longer period of time. Probably a great time to connect with a financial advisor, start a plan, figure out how you want to allocate, where you want to allocate. Clients and prospects can reach out to us. They can go to our website, call, and meet with an advisor and learn a little more.
Absolutely, 100%.
Charlie, thanks for your time. Thanks for joining us.
Thanks for having me.